Hello, I'm BrianZen. I teach investment analysis at St. John's University. I manage money for private and institutional clients with a New York investment firm. I have earned an MBA in accounting, a PhD in finance, and I have passed all the 3 CFA exams. In this study session, we talk about bond valuation. As you know, the Level 2 CFA exam is a valuation test. All the issues will be discussed under the light of how to value a particular security. The fundamental principle of valuing a debt security is essentially the same as the valuation for an equity security. You look at the future cash flows that you are going to receive from this particular security, and then you use the appropriate discount rate to discount all these future cash flows to get the total present value. And that present value, if it is lower than the current market price, you try to sell that security. If the present value of all your future cash flows is above the current market price, it means your security is undervalued, and you try to see if you want to buy that particular security. The fundamental principle of security valuations is all essentially the same: to use the appropriate discount to discount all the future cash flows to get the total present value. To value a bond, you would look at the coupons that you will be receiving. And then at the end of the time horizon, when the bond matures, you are going to get your principal back. So the last cash flow is the principal payback plus the last coupon. You use the correct discount rate to discount all your future cash flows to get the current bond price. If we take a look at a zero coupon bond, a zero coupon bond doesn't pay any coupon during the years that you have been holding it. It's only at the end of the time horizon. Let's say if it's a 10-year zero coupon bond, at the end of the 10 years, you get your $1,000 back per bond. So the par value is going to be $1,000. Let's say this is a 10-year bond. We always use semi-annual convention for zero coupon treasury bonds. So 10-year multiplied by 2, you put in 20 here because we're using semi-annual compounding. And let's say the current risk-free rate is 5%. You use 5% divided by 2. 2.5% is the semi-annual yield that you require from your investment. You put these numbers into the calculation, you would be able to get the correct price for that particular zero coupon bond. When we value a bond, we first need to project what kind of cash flow we will be receiving in the future years while we're holding this bond. However, certain structures of particular types of bonds have uncertain future cash flows. Let's take a look at 3 of those type of bonds with uncertain future cash flows. The first type of bonds with uncertain cash flows are the bonds with callable or puttable features. Here, if a bond is callable, the issuer will have the right to pay you early, to call your bond certificates and pay the $1,000 bucks back to you. So when the interest rate drops, the issuer see that they would be able to borrow at a new, lower interest rate at the current market situation. They would probably call the bond back, pay you early, and then go to the market to borrow at a lower rate. So if they call them, the future cash flow pattern of your bonds will be totally changed. You will be getting your principal back much earlier. If a bond is puttable, you have the right to put the bond certificate back to the issuer, demand for your $1,000 back if that bond price is not doing too well, if it's dropping because of the interest rate rising or whatever reason. So if you decide to put the bond back, you're getting your principal back much earlier. The cash flow pattern changed. The valuation of those type of securities will be much more complex. You'll have to calculate the probabilities of the cash flow changes. The second type of bonds with uncertain cash flow is the floating rate, LIBOR. Those type of bonds, they have interest rate being set periodically. So when the market interest rate changes after 1 quarter or half a year, the interest rate from your bond changes. So the valuation of those type of securities will have some other complex issues involved. The last type of bonds with uncertain cash flows are the convertible or exchangeable. Those type of bonds can be converted to the common stock. So if the company do very well, the stock shoots up to the sky, and you decide to convert your bonds to the common stock, the cash flow pattern that you will be receiving from that particular convertible bond will be changed, and then a whole set of valuation issues will be dealt with if a bond is convertible. Another key aspect of bond valuation is to use the appropriate discount rate to discount all the coupons and the principal payback that you will be receiving for your bond. The appropriate discount rate to use is the sum of the risk-free rate and a risk premium, usually called a nominal spread. If there's options involved with your bond, it's usually the option-adjusted spread, or sometimes if you are looking at the spread over the entire yield curve, it's called zero volatility spread. Usually in practice, people use the yield for the on-the-run U.S. Treasury securities using the same maturity as the average maturity of your bond, and then plus a certain spread. Essentially, if you are trying to value a 10-year corporate bond, you look at the 10-year on-the-run U.S. Treasury yield plus whatever spread you want from this particular company, depending on the risk profile of that company. To be more precise with your valuation, we use what is called an arbitrage-free valuation approach. Here, we try to apply the spot rate. Use the spot rate for a certain year to discount the coupon that you are going to receive for that particular year. As you know, when you use your calculator to do the yield to maturity calculation for your bond, you are essentially using the same yield maturity for all the coupons and for the principal payment. That's a big simplifying assumption. In the real world, as the time goes by, as the maturity increases, the interest rate that you will be getting increases. So the precise method to calculate the present value of those bonds is whenever you receive that particular cash flow, you should use the spot rate of that particular period to discount that particular cash flow. After you have calculated the present value of all these coupons and principals, you would get the total present value. You compare that total present value to the market price to determine if there is an arbitrage opportunity or not.